Every single morning at 8:47, Marcus glides into the office park driving a sleek, midnight, Finnish sports SUV that he secured on an expensive short-term lease just under a year ago.
His monthly obligation stands at a staggering $839 over 3 years.
He deliberately claims the closest visible space near the main entryway, not for convenience, but because that specific spot is directly overlooked by the glass, walled boardroom where his corporate
division gathers every single week. Marcus operates as a mid-level promotional coordinator, pulling in $94,000 annually.
Whenever prospective corporate partners arrive for high-stakes briefings, he is always the precise individual who escorts them back down to the ground floor, making absolutely certain they catch a
glimpse of the gleaming vehicle before they depart.
That imports badge is not mere utility. It functions as an aggressive status symbol constructed out of precision engineering and recurring debts he can scarcely manage. But what if his entire presentation is a calculated illusion masking a severe financial crisis? Meanwhile, Evelyn positions her vehicle in the furthest rear quadrant of that exact same paved lot by 8:22 a.m.
She operates a standard, utilitarian sedan acquired, pre-owned 3 winters back for $22,400 in upfront cash.
A noticeable scrape indents her trailing body panel, an imperfection she systematically chooses to overlook since it has zero bearing on the mechanical performance of the machine.
Evelyn fulfills a critical role within the identical enterprise, managing the entire structural workflow as director of internal systems.
Her base compensation hits $112,000 a year.
Marcus maintains an aggregate personal net asset valuation of just $17,000, heavily weighed down by outstanding revolving credit card lines, the ongoing automotive lease burden, and unsecured
signature loan obtained for an exotic tropical getaway last winter, and a retirement balance hovering around $8,200 that he only funds at a minimal 2% rate.
Evelyn boasts a net asset valuation of $1 million. Marcus projects immense affluence, whereas Evelyn possesses genuine wealth.
They share the same workspace, capture equivalent professional revenue bands, yet their ultimate economic destinies remain light, years apart, forged by completely opposing everyday behaviors. The massive divide separating their underlying monetary outcomes can be traced directly to the machines resting in those parking spaces.
One selected immediate social validation, the other prioritized long-term asset accumulation. The vehicle purchase was the exact moment their trajectories diverged permanently. This presentation breaks down precisely why the most fiscally secure individuals across the nation routinely, almost without exception, drive highly unpretentious vehicles that would completely
shock you.
They do not make these choices due to a lack of capital, but because their core philosophy regarding wealth is so fundamentally distinct from traditional consumer habits that their choice of
Transportation serves as the clearest manifestation of the wealth-building principles that generated their fortune in the first place.
Let us dive straight into the data. The precise median expenditure recorded by established millionaires for their most recent vehicular acquisition was exactly $31,367.
For ultra-wealthy individuals holding a baseline of $10 million or higher, that acquisition metric only rose to $41,970.
This empirical data is derived from comprehensive national wealth registries detailing modern affluent spending patterns across the continent.
To put these figures into perspective, consider this shocking contrast. The typical transaction amount for a brand new automobile in the current consumer market has now soared past $48,000.
This means the typical middle-class consumer is routinely committing significantly more capital toward an initial car purchase than the average millionaire allocates toward theirs.
Furthermore, an automotive consumer behavior analysis revealed that an overwhelming 61% of high-earning households pulling in over $250,000 annually intentionally choose
mainstream brands like Hondas, Toyotas, or Fords, 61%.
These are affluent families generating massive yearly revenues who could easily write a single check for an elite European luxury utility truck.
yet the absolute majority prefer commuting inside
everyday sedans or standard utility pickups. Only a minor 39% of those elite earning brackets opted for high and luxury nameplates whatsoever.
The single most dominant automotive brand chosen by verified millionaires remains Toyota, followed closely by Honda and then Ford.
Prestigious continental brands failed to even crack the top 3 positions on the registry.
Additionally, a mere 5% of wealthy individuals operated a vehicle manufactured within the current calendar year.
The underlying data indicates that over half of these affluent drivers steered vehicles that were older than 2 years.
The typical millionaire navigates daily traffic in a machine averaging roughly 4 years of age, showing approximately 41,000 original miles.
These are not citizens constrained by a lack of purchasing power. These are strategic actors who fully grasp a fundamental economic reality that the general public has been systematically
conditioned to ignore. Automobiles represent the absolute most devastating wealth, destroying mechanism within the modern consumer landscape outside of primary residential real estate.
A car is a depreciating anchor, dragging down your financial freedom. Unlike residential property, which at least maintains the structural capability to gain baseline value over extended periods, a vehicle experiences immediate fiscal destruction the exact second you execute the final dealership contracts. A brand new machine drops approximately 20% of its total capitalized value within its initial 12 months on the pavement. By the 5th year of ownership, it has surrendered roughly 40% of its sticker value.
By the 7th year, the vast majority of consumer vehicles retain less than 1/3 of their original showroom pricing.
Yet, the typical monthly vehicle obligation across the nation escalated to an unprecedented $767 by the start of 2026. A massive segment of the population now willingly carries monthly car debts exceeding $1,000.
Extended 84-month financing structures representing 7 full calendar years of relentless monthly extractions are becoming entirely normalized across major dealerships.
This means millions of working citizens are consistently writing massive checks for a piece of machinery that is worth significantly less than the underlying balance they owe on the debt for
Vast majority of the contract's duration.
They are completely underwater, trapped in negative equity, pouring hard, earned income into a vanishing asset instead of funneling those exact same dollars into wealth, generating investment
instruments that compound over time. Let us analyze the exact mathematical reality of this scenario, because the actual numbers are where the financial damage becomes incredibly stark.
Marcus leases his premium sports SUV at $839 every single month. Throughout his 36-month contractual term, he hands over a total of $3,204 to the financing firm.
When the contract expires, he walks away with absolutely zero equity.
He surrenders the keys and immediately signs up for an identical premium lease because accepting a more modest, practical vehicle would feel like an unacceptable social downgrade.
He will likely sustain this precise cycle for roughly 30 years of his active professional career, redirecting an average of $800 every month toward an asset he will never actually own. Evelyn, conversely, secured her modest sedan for $2,400 using upfront cash. She intends to operate that machine for a full 8 years.
Her comprehensive cost of vehicle utilization, factoring in basic upkeep, insurance variances, and the initial cash outlay, breaks down to an estimated $330 monthly across her total timeline
of ownership. At the conclusion of that 8-year window, the vehicle remains perfectly functional.
She divests it for $9,000, acquires a comparable pre-owned model for $23,000, and seamlessly restarts the process.
The immediate monthly variance between Marcus's lease, heavy lifestyle, and Evelyn's cash-based strategy is roughly $500.
Think about that. $500
every single month.
If you channel that exact $500 monthly delta into a standard index fund yielding a conservative 8% annualized return across a 30-year professional career, that single recurring
Difference compounds into a massive sum of approximately 745 $0. Let that specific number truly sink into your consciousness.
Nearly $750,000.
That is not a speculative, hypothetical projection. It is the direct mathematical inevitability of the profound gap separating an $800 monthly commitment from a $300 alternative.
Compounded across a working life, it represents the ultimate boundary dividing a retirement defined by abundant choices from a retirement plagued by constant survival anxiety.
It is the core difference between achieving absolute financial autonomy at age 60 versus enduring mandatory corporate dependence at 75, all dictated by the specific machine sitting in
your driveway right now, a selection you likely finalized based on how it would project your status to random onlookers.
Evelyn's one. $1 million net worth did not materialize through an esoteric trading formula or a windfall family legacy. 88% of verified modern millionaires are entirely self-made, according to extensive national wealth studies tracking thousands of affluent citizens. Evelyn belongs directly to that majority. She constructed her personal fortress entirely within the profitable margin separating her actual income from her total lifestyle expenditures, and her vehicular strategy is precisely where she insulates the single largest chunk of that profit margin.
Her specific automotive decisions alone are directly responsible for roughly $600 of her aggregate net asset valuation, accounting for more than half of her entire financial empire from age.
Single disciplined choice, initiated decades ago, and systematically repeated every 8 winters since. Broad wealth research confirms that 94% of millionaires systematically live far beneath their maximum financial capabilities. Only 31% maintained an average of a 6-figure income throughout their primary working careers.
Remarkably, fully 1/3 of these wealthy individuals never cleared the $100,000 annual compensation threshold in any single calendar year of employment.
The top 5 professional classifications appearing on these millionaire registries were engineers, certified accountants, public school educators, mid-level administrators, and attorneys.
Public school teachers, a demographic universally recognized as structurally undercompensated, consistently materialized on verified wealth tracking lists with greater frequency than high, and
medical specialists or elite technology developers. Why? Because the specific career field never dictates the ultimate wealth outcome.
the size of your savings margin does, and the garage is precisely where the vast majority of consumers completely destroy that margin before it can ever compound.
While this may not constitute individualized financial consultation, it is vital to comprehend why the automobile specifically, out of all potential consumer spending categories, acts as the ultimate separator of long-term wealth outcomes more decisively than almost any other variable. There are 3 core reasons for this phenomenon.
The first element is sheer magnitude. A monthly vehicular obligation represents the second heaviest recurring expenditure within the standard household budget, outranked only by primary housing costs.
Pouring $767 a month into a car exceeds what the typical family allocates toward monthly nutritional provisions.
It eclipses what the majority of citizens put toward active retirement accounts or liquid emergency reserves. When this individual budget line is artificially inflated by $300, $400, or $500 beyond what is fundamentally required for safe, dependable transit, that excess consumption
Completely overpowers every other positive economic action you try to take.
You can aggressively cancel every streaming platform, brew your morning beverages in your kitchen, pack your mid-day meals religiously, and painstakingly negotiate every utility bill, yet aggregate savings harvested from those minor sacrifices will still never neutralize the massive structural deficit between a $400 car obligation and a $900 lease payment.
The vehicle is the massive boulder. The gourmet coffees are mere pebbles.
Traditional monetary commentary focuses almost exclusively on the pebbles because minor behavioral tweaks are comfortable to discuss.
The massive boulder is where your actual wealth is won or lost. The second major structural element is duration.
Unlike a weekend resort getaway, a premium dinner party, or a designer wardrobe purchase, an automotive obligation permanently locks down your capital for multiple calendar years.
60 months, 70, 2 months, 80, 4 months.
It functions as an unceasing, automated extraction flowing straight out of your economic life, operating on absolute autopilot for the better part of a decade.
Because this mechanism is completely automated, your psychological framework rapidly habituates to its presence.
By the 6th month of ownership, you no longer actively register the pain of that massive line item.
It simply blends into your baseline economic scenery. You subconsciously reshape your peripheral spending around its demands, passively accepting it as an unalterable fixed cost of modern existence.
But it is completely variable. It was an explicit choice.
A singular decision finalized on a random Saturday afternoon at a retail dealership showroom now systematically drains $767 from your bank account every single month for 7 years, while
Physical asset it secured continuously drops to half its value. The third critical variable is intense social expectation.
No other standard retail purchase commands the same degree of public personal identity as your choice of vehicle.
Your machine is constantly witnessed by your immediate neighbors, your professional colleagues, the individuals you date, the parking attendants, and your extended family members when you pull in
their driveway for holiday gatherings. It broadcasts a highly visible narrative regarding your professional identity, your estimated earning power, and your relative position in the social hierarchy.
That public narrative is almost universally a total fabrication, but the casual audience has no means of verifying the underlying reality.
The passing public notes a premium European badge and immediately presumes massive financial success.
That same public notes a standard 2020 sedan and instantly presumes mediocrity at best.
The societal algorithms dictating car ownership are so profoundly woven into our modern culture that the vast majority of citizens would honestly prefer to be entirely broke inside a prestigious
machine than completely solvent inside a plain one. Marcus perfectly illustrates this cultural affliction.
His imported utility vehicle demands an $839 monthly payment, plus an additional $347 in monthly insurance premiums since high-performance luxury platforms carry much steeper risk.
Profiles plus premium grade fuel running roughly $20 to $30 more per tank than standard unleaded options.
His total comprehensive monthly automotive overhead blows past $200, funded by a $94,000 gross income.
This means roughly 15% of his total pre-tax earnings is being sacrificed directly to an asset experiencing aggressive mechanical depreciation.
Traditional wealth managers universally recommend keeping total aggregate transportation costs, encompassing financing, insurance, fuel, and standard maintenance, strictly below 10% of your
gross monthly revenues.
Marcus is sailing a massive 50% above that critical safety boundary every single month for 3 solid years, at which point he will willingly reset the destructive cycle.
Evelyn's complete monthly automotive overhead, averaged smoothly across her full timeline of ownership, hovers at just about $480, encapsulating long-term amortization, insurance coverage,
fuel consumption, and routine shop maintenance, measured against her $112,000 salary that represents a modest 5% of her gross monthly revenues.
She is operating at exactly half the maximum recommended safety threshold.
The structural variance between allocating 5% versus 15% of a 6-figure income band equates to roughly $8,300 every single year.
That is the hidden annual wealth transfer flowing straight out of Marcus's long-term future and into the corporate balances of the leasing agency, the insurance conglomerate, and the municipal
fueling stations sustained year after year, decade after decade. Meanwhile, Evelyn captures that identical $8,300 annual variance and systematically feeds it directly into a broad market index fund, allowing it to compound quietly at an 8% average rate until the aggregate balance displayed on her investment dashboard stops looking like real money and starts looking like total freedom. Consider a profound insight preserved within classic wealth architecture texts tracking affluent behavior.
Researchers identified a highly specific cohort of wealthy individuals classified as chronic pre-owned vehicle purchasers.
These specific millionaires consistently selected used machinery over brand, new showroom alternatives.
They systematically registered the absolute highest marks for personal thriftiness of any subcategory within the comprehensive National Wealth Database.
Crucially, they also maintain the most extreme net worth to income ratios ever recorded, meaning that for dollar of actual revenue earned, these used car millionaires accumulated far more
structural wealth than any other segment of affluent citizens in the entire research project.
They consistently directed a significantly higher percentage of their annual revenue toward active investments than any peer group,